Welcome back to The Explainer. Today, we're lifting the hood on Acadia Realty Trust, or AKR, to see exactly how a modern real estate giant is engineering some truly impressive momentum right now.
And I mean, just look at this. Our source data kicks off with this massive market beat headline from mid-2026 showing Acadia smashing through to a new 12-month high. Now, hitting highs like that in today's real estate climate, well, it's honestly no small feat. It immediately begs the question, what exactly is fueling this massive surge? So to figure that out, we're going to break this explainer down into 4 quick parts. We'll look at their dual platform strategy, their recent financial growth, their dividend history, and finally, we'll peel back the curtain on how their executives are actually getting paid. Right, let's dive straight into Section 1, Acadia's dual platform strategy, which is really the absolute foundation of their business model. So what makes Acadia tick is this brilliant structural advantage. It's kind of like a 2-engine setup. On one side, you've got their core REIT portfolio. This is their rock-solid foundation, heavily focused on must-have high-traffic street retail and open-air properties. We're talking premium, absolute top-tier locations, places like Chicago, Washington, D.C., and Madison Avenue in New York. But then, perfectly balancing that out is their investment management arm. This side uses institutional co-investment vehicles to hunt down opportunistic value-add acquisitions. Basically, it gives them the agility to pounce on high-return deals without over-leveraging their safe core portfolio. So now that we know how the engine works, let's jump into Section 2 and trace their financial momentum from 2024 up into 2026. We're going straight to the source documents here. Looking back at their Q2 2024 earnings report, you can spot the early signs of this huge acceleration. They posted a solid 5.5% core same-property growth. But the wild part? A massive 55% cash leasing spread on new leases, heavily driven by that street portfolio we just talked about. Basically, when old leases expired, the new tenants stepping in were paying significantly higher rents. Now, really quickly, before we hit the latest 2025 and 2026 numbers, just a brief refresher, because real estate has its own dialect, right? FFO, or funds from operations, is your big picture metric tracking overall corporate cash flow by stripping out paper losses like depreciation. NOI, or net operating income, zeroes in on the property itself. How profitably is that specific building running, day to day, revenues minus operating expenses? Okay, keeping that in mind, look at how dramatically things sped up by the end of 2025. FFO climbed to $1.32 per share. Same property NOI growth bumped up to 5.7%, and those gap leasing spreads, they literally jumped to a staggering 60% in Q4 of 2025. That was almost entirely fueled by aggressive leasing in their key street retail corridors. They are commanding massive premium rents simply because their properties are sitting exactly where the top retailers are desperate to be. But here's the thing. They aren't just sitting back collecting rent on existing assets. Just take a look at this number. $503 million. That massive figure represents the value-adding acquisitions Acadia closed in just the first quarter of 2026 alone. They vastly expanded both of their platforms in basically the blink of an eye. And you can really see that dual strategy playing out perfectly here. Out of that $503 million, $424 million flowed right through their investment management side, including a huge joint venture with TPG Real Estate to snap up the shops at Skyview in Queens. Meanwhile, they're aggressively churning older assets. They sold off a stabilized property called Lansdowne Commons for an incredible 17% internal rate of return, nearly doubling their money. And they didn't even pause to take a breath at the quarter's end. They added another $109 million street retail portfolio right after. It's a brilliant balancing act. Massive institutional scale on one side, hyper-targeted street retail on the other. All right, with all that cash flowing, let's move to Section 3 and talk about what this means for you. Consistent dividends and reliable shareholder returns. As you can see right here, Acadia has delivered a really steady, reliable step-up in total annual dividends per share. The progression is super clear. 72 cents total in 2023, bumping to 74 cents in 2024, and climbing to a robust 80 cents per share by the end of 2025. This is a perfect visualization of their underlying cash flow growth actually making its way back into the pockets of shareholders. And the good news is they haven't pumped the brakes in 2026. Checking their latest schedules, they've firmly locked in that 20-cent quarterly payout through mid-year, maintaining that strong annualized baseline of 80 cents. For income-focused investors, getting this kind of predictable, well-supported yield right alongside serious capital appreciation is, well, it's exactly what you want to see. So how do we know they'll keep this up? Let's jump into Section 4, Leadership and Executive Compensation, where we connect those financial metrics directly to human incentives. This is where it gets really interesting. Digging into the proxy statements, CEO Kenneth Bernstein operates on an incredibly strict pay-for-performance model. Just look at how his annual bonus is sliced up. The bulk of his compensation is tied directly to the exact metrics we just reviewed. 22.5% relies on hitting FFO targets, 20% is based strictly on leasing activity, another 17.5% is tied to transaction volume, like all those massive acquisitions we discussed earlier. They are literally paying their CEO to execute the specific, exact financial growth plan that we are seeing play out in the earnings reports. And it definitely is not just about short-term cash grabs either. Their long-term equity vest over multiple years and is strictly gated behind beating industry indexes and achieving that vital same-property NOI growth. Plus, they've got this super unique promote interest program. It basically allocates 25% of their joint venture outperformance directly to the employees. So if that investment management side crushes it for their institutional partners, the Acadia team gets to share in the upside. And those earned units, they cliff vest over a 3-year period, meaning they get them all at once at the very end, with extra holding requirements baked in. But to ensure total alignment with the shareholders, with us, the governance rules go one step further. The CEO is actually mandated to hold company stock equal to 10 times his base salary. And looking at the latest data, he has successfully met that requirement. Talk about serious skin in the game. If the stock drops, the CEO feels the pain right alongside the retail investors. So what does this all mean for the future? With a robust pipeline of must-have street retail currently in advanced negotiations and a management team financially hardwired to execute, the million-dollar question is, will this aggressive momentum keep pushing Acadia's stock to unprecedented new highs as we move into 2027? It is definitely one to watch. Thanks for joining me on this explainer, and I'll catch you on the next one.